All right, so I'm David Swear. I'm a professor of finance here at Haas. I have the pleasure of chairing this session on big data and artificial intelligence to expand access to credit. The first speaker will be Paulina Medina from the Mays Business School at Texas A&M, and she will present a paper on leveraging detailed payment history data for better credit scoring methods to improve women's access to credit. That's a long title.
It is. All right, good afternoon, everyone. Thank you for joining us for this presentation about alternative ways of calculating credit scores to increase access to credit. This is joint work with Josh, Laura, Paul, Sean, and Enrique, who are all here, and we are all looking forward to hearing your thoughts and comments on this very preliminary work in progress. In this project, the big picture motivation is understanding the reasons behind the gender gap in access to credit and providing some direct recommendations of how to mitigate it. On the one hand, as we saw earlier this morning, we know that women default less than men, even after controlling for observable characteristics. But on the other hand, we know that women are less likely to get access to credit. When they get access to credit, they do it at higher interest rates or with lower loan amounts. So in this project, we argue that this is partly because of the way in which credit scores are trained and deployed. In particular, we note that the main input on a lot of traditional credit scores are credit bureau records. But if women have historically been left out of credit markets, this creates a missing data problem that in turn creates a cycle of exclusion, because to get a better credit score, you need to have access to credit, but to have access to credit, you need to get a better credit score. And the second feature that we note is that in most models, gender is excluded from credit scoring models, partly because of legal considerations. And when gender is included in the calculation of credit scores, the modeling choices are usually such that do not allow to capture the complex ways in which different features can predict repayment behavior. So what we're going to do in this project is that we're proposing gender differentiated credit scoring algorithms that will be trained with a different type of alternative data. This gender differentiated credit scoring algorithm basically refers to the idea of training basically models separately for men and for women. And we're going to do that with a new type of data that is available both for individuals that already have access to credit, but also for individuals that do not have access for credit, solving this missing data problem as well. And we're going to do that in partnership with RappiCard Mexico, that, as we saw earlier, is a very cool company that is the fintech arm of the leading on-demand delivery platform in Latin America. What is an on-demand delivery platform? Well, as Paul mentioned earlier, we can think of this as something like Uber Eats meet Amazon. Basically, you have an app in which you can request a lot of things to be delivered to you. And I'm going to talk about that in a little bit. And in partnership with Rappi, we're going to try to answer several questions about these gender differentiated credit scoring algorithms trained with data from Rappi. The first one is, can these algorithms increase access to credit for underserved women? And what is the impact in the profitability for lenders if we keep the risk preferences for the lenders fixed? Can we actually increase access to credit in a profitable way? And ultimately, at the core of all this is getting a sense of what's going to be the impact in the lives of the women that will get access to credit with these algorithms, both in terms of tangible economic outcomes, but also in terms of several measures of psychological well-being. In particular, the project has two stages. The first one is the training of these algorithms. And once we have these algorithms fully trained, we're going to have basically two categories of models. One that are trained pooling men and women, those we can call those the pool models. and another category of models that are going to be trained separately for men and women. And what we're going to do is identify women that are rejected by the pool model and approved by the segmented models. And among them, we're going to randomize access to credit. And we're going to do that by randomizing the credit scoring model that's assigned to women in this population to be able to study and answer the questions that I mentioned earlier. But let me start by telling you, why do we need these alternative types of data? The idea, as I mentioned, is to break the cycle of inclusion. So we need data that is available for people that don't have access to credit, and we need data that is sufficiently rich to tell us something about the repayment behavior of these individuals. And we know that everyone in the room knows that prior work has worked that we can use a lot of flexible models to use data from, say, call log records to predict wealth, to target government programs, and for loan repayment. And we also know that recent regulations, as Josh was mentioning yesterday, have led to limits in the availability of certain types of data that we know for predicting repayment. So we need to look for alternative sources of data to predict repayment. And turns out that the digital footprints that people left behind when they interact on different digital platforms has proven to be useful as well in predicting repayment behavior. So what we bring about is a new type of digital footprint data, which is all the evidence that people left behind when they are interacting with this delivery app that is very rich in the products and services that offers to their clients. This is how the Rappi app looks, and you can see that we have access to data not only on restaurants, that's pretty much like Uber Eats, but also groceries, pharmacies. I can know if you requested a COVID test. Laboratory tests are also available on Rappi. We know a lot about cash in two ways. First, you can request a delivery person to bring you cash that will be credited, that will be charged to your debit or credit card account on file. But you can also pay with cash if you don't have a debit or credit card account on file, no? Which is a group particularly of interest for us. They have air travel, they have special deliveries. That means that you can just get someone to deliver anyone for you, bring object A to person B, no, in a very straightforward way. They have crypto payments. If you have cryptocurrency, you can transform that into Rappi Credit, and they have other retail shops as well. And so we think that with this data, we should be able to fill this gap of alternative data sources that are available to fill the missing to resolve the missing data problem for people who do not have access to credit. But for the second part of the analysis, let me tell you a little bit about why we think that gender differentiated algorithms can be useful to expand access to credit. To build some intuition, let me tell you about an issue that has caught a lot of attention in recent years in the medical community. Heart attacks in women are much more likely to be undiagnosed than heart attacks on men. Think about the diagnostic of a heart attack as a prediction exercise in which we want to find a mapping between a combination of symptoms and the event of a heart attack. If I ask you what is the most common combination of symptoms of a heart attack, you'll probably tell me there is a very squeezing pain in the chest that spans to the shoulder and the upper section of the arm. That's definitely true for men. But turns out that women experience heart attacks in a different way. There is also some pain some discomfort in the chest, usually of less intensity, but this comes accompanied by pain in the upper back, pain in the jaw, indigestion, nausea, and extreme fatigue. And turns out as well that because of biological reasons and health habits, men are a lot more likely to suffer heart attacks than men. So the vast majority of the research in this domain was made with samples in which women were explicitly left out or severely underrepresented in a 70-30 ratio. So in this sample, if you look through the data and try to figure out what is the combination of symptoms that best predicts a heart attack, it is indeed the single pain in the chest. But if you split the sample in men and women, you'll see that the combination of symptoms that best predicts a heart attack for men and for women is differently. And probably your mind is already buzzing with a lot of analogies between what I just described and the credit scoring exercise, because the idea is the same. We want to predict repayment behavior instead of a heart attack, and we have a number of features that may interact in very complex ways. And we want to figure out, we want to allow for those interactions to be different for men and women. And we want to do that because indeed we have a lot of evidence that men and women behave differently in many aspects of their lives. On the one hand, we know that women are more reluctant to compete than men. Women are more risk averse and less self-confident, and women are less responsive to certain types of monetary incentives. So it seems like the determinants of repayment could actually be different for men and women, and that we can use simple machine learning models to jointly optimize on two stratified subpopulations, namely men and women, to allow to recover the complex ways in which different features affect repayment behavior in a different way for men and women. We have some preliminary analysis with data from RapidCard Mexico that we were just looking at next week. It's in definitely early stages, but there seems to be some evidence that indeed there is a significant fraction of applications for which a gender differentiated credit score and a pool credit score would lead to different credit recommendations, would lead to a different composition of the user pool and indeed expand access to credit. Ultimately, we care about a lot of outcomes related to this exercise of expanding access to credit with gender differentiated credit scoring algorithms, in particular those related to profitability for the firm, to do this as part of a for-profit operation that can expand access to credit in a profitable way, no? And we also care ultimately about the outcomes that affect the financial lives of women that would be getting access to credit. So we plan on looking at several of these fundamental measures of the benefits of credit risk that include a variety of economic outcomes and psychological outcomes as well. We think this project has several implications because on the one hand, access to credit can fundamentally transform the lives of millions of women that don't have access to credit right now. And this impact can be particularly large among individuals who do not have access to credit, for which the marginal dollar in access to credit is all the more valuable, specifically in the form of formal credit that will indeed create a credit bureau record for them that will allow them to access a full range of other financial services in the future. We think these results, once we have the results of this project, we think this can influence credit origination in countries in an incentive-compatible way in places in which it is allowed to use gender in credit origination, but importantly in places in which it is not allowed to use, is not legally allowed to use gender in credit origination. We think that this could spur the conversation about whether it should or not be used for credit origination, particularly speaking to this question about the debate about gender-blind algorithms that many people think are the best way to protect minorities. We're excited about the steps ahead. We are currently working on the ML model. We will then move forward to a pilot stage, and we are looking forward to scaling this up in an RCT and to be back and telling you all about the results that we find.
Thank you very much, Paulina. That was very interesting. So we have a few minutes for questions. If there are any questions in the room.
Yes.
I know you said that you're still developing the algorithm, but do you have any intuition about what the predictors might be for men versus women, or is it not kind of interpretable by humans?
So we haven't looked at all the details yet. I mean, I guess the idea is that women may have different sources of income than men, and that the different types of spending patterns that they have could be reflected into the purchases that they have on the Rappi app. And I wouldn't be surprised if those patterns of spending would lead to different predictive power for men and for women, mainly because the preferences of men and women are different. The products that a woman would be buying, that would be correlated with high repayment behavior need not be the same as the products that a man would be buying that would be correlated with high repayment behavior.
Okay, great. I wrote this question down thinking it was going to be a cheap, annoying question, but I guess this highlights the value of presenting work at a really early stage because it may or may not be relevant. Is I was kind of wondering, it sounds like you're only planning on randomizing among kind of like the inframarginal group that would be excluded with the traditional algorithm and included with the alternative algorithm. But there's also the flip side, and there's also the implications for men. And I was wondering, like, in some sense, if we wanted to understand what was happening with welfare, it would be really nice to kind of include all of those within the design. So I was wondering if you thought about that. And I was also wondering if there's kind of any implications in terms of amounts. So kind of like among those who are not marginal, would the amount vary across the two algorithms, or is this really like a yes or no?
Yeah, I mean, I think those are great questions in terms of who would be the experimental pool. With the results that we are seeing, that there is a recomposition of some people that would be approved under the pool model and denied under the new model that could lead to a change in the quality of the experimental pool. I think we're probably going to revise who enters in the experimental pool. The original proposal was really focused on this group that would be expanding access to credit, but the very preliminary things that we're seeing makes it really look about the composition of the experimental pool that includes people coming in and coming out. And yeah, I mean, depending on the sample sizes that we are able to pull out, we may actually expand that also to men and to men as well. In terms of the credit, the way I think about it, the credit that we would be assigning, we have not fully, we would certainly like to look at variations in the size of the credit limit, in the size of interest rates. We will consult the feasibility of all these changes with Luz to see if there are any logistical considerations in play. But I do think that it would be very interesting to, as I described in the motivation, it's the probability of having access, the amount, the extensive and intensive margin, amount of the loan and interest rates as well. Yes.
No, thank you very much for the presentation. Very, very interesting paper. I have one question regarding when you disaggregate this information, so probably you're going to increase credit to women. That's the hypothesis. But also at the same time, you can lower provisions for women. And this is a really good business, not only for Rappi, but also for other financial institutions. And I think the Mexican regulator is trying to do something on that regard.
You are right. Among regulated institutions, the Mexican regulator has different provisions for men and women. Having said that, Rappi is under a different, is not a bank. Rappi is a joint venture between a bank and the delivery platform. They, my understanding is that by regulation, they don't need to set reserves for the cards, but they do. Nevertheless, they set reserves, and I think it would be a very interesting business implication if we improve the quality of the user pool, that they indeed can set lower reserves and increase the profitability in that margin as well. Right?
You've made the generalized statement that women are better credit risks than men. Does this follow across all categories of women, in terms of income level or in terms of profession? Might this work against women in some situations as well?
So I think the question of heterogeneity is always very interesting. We know that women of comparable characteristics that men have a better probability of repayment. We also know, kind of like related to what we were discussing yesterday with Josh about having like a certain objective function and utilizing the algorithms to achieve that objective function. I could very well see that if the objective function includes some feature of equality or some idea of not making anyone worse off, that could be incorporated once the algorithms are developed. So in a way, for now, we want to figure out what is the predictive power of these algorithms and what is the impact that they can have on the life of women. But for sure, once the technology is developed, one could apply it to different objective functions, not only access and not only picking the better credit, but maybe some other objective function in which a more egalitarian outcome is sought for.